Congressman, the ranking member, Congressman Cartwright's on his way. And as I think the witnesses know, we have some other hearings going on. But I will now recognize the Vice Chair of the committee, Mr. DeSantis, for an opening statement.
Thanks, Mr. Chairman. Thank you to the witnesses for coming today, and appreciate your flexibility. Obviously, we have a hearing downstairs that's taken quite a while. Millions of Americans are out of work, millions are unemployed, and millions have given up looking for a job. A top priority of this Congress should be to remove barriers to job creation so Americans can get back to work, and small businesses are the key to this goal. They provide half of all employment in the United States and 42% of all payroll spending. Most importantly, small businesses are the leader in creating new jobs. If small businesses are the engine of job creation, then community banks are the engine of small business, because community banks are the leaders in making small business loans. At the end of 2010, community banks held $160 billion in small business loans on their books, representing almost half of all outstanding small business loans. In other words, 1 out of every $2 lent to a small business comes from a community bank. Community banks, characterized by local ownership, local control, and local decision-making, are best positioned to evaluate the precise business environment in a local community. Furthermore, community banks' ability to offer highly customized financial services ensures that each small business receives products that are tailored to fit that business's individual needs. Congress has an obligation to support and promote the business model that community banks have used so successfully. Unfortunately, the regulatory regime imposed by the traditional banking regulators, as well as the Dodd-Frank Act, needlessly raised community banks' costs of doing business. There will be only one consequence from this regulatory burden: a reduction in community banks' ability to serve their communities. Fewer services will be offered, fewer loans will be made, and those loans that are made will come at higher prices. Fewer small businesses will get off the ground, and less Americans will have a good job. This regulation is not necessary. It seeks to solve a problem that doesn't exist. Just 2 weeks ago, the Comptroller of the Currency, one of 3 primary banking regulators in the U.S., emphatically stated, quote, "Community banks and thrifts had nothing to do with bringing on the financial crisis," end quote. Yet community banks all across the country are feeling the brunt of the Federal Leviathan. This demonstrates a truism that is not unique to banking. Big, burdensome government typically gives big business a competitive advantage over existing and would-be small businesses. As J.P. Morgan CEO Jamie Dimon explained, increased regulatory burdens make it easier for large firms to gain market share because they create substantial barriers to entry for smaller competitors. The sad thing is that much of the regulatory burden faced by community banks does not serve a compelling purpose, but is simply an exercise in rote compliance. If the official position of this administration is that community banks were in no way responsible for the financial crisis, then why are we subjecting them to such onerous regulation? The fundamental goal of this hearing is to understand just how burdensome Federal banking regulations have become on our community banks and, in turn, how that affects our small businesses. I thank our witnesses with their individual expertise, and I thank them for being here. In particular, I would like to thank one of my constituents, Eddie Kramer from St. Augustine, Florida. He is a community banker in my district, to offer his personal experience as a community bank leader. Mr. Chairman, thank you for having this hearing, and I yield back the balance of my time.
I thank the gentleman for his statement, for his hard work in Congress, and specifically for helping us put this hearing together. Now recognize the ranking member, the gentleman from Pennsylvania, Mr. Cartwright.
Thank you, Mr. Chairman, and thank you, Mr. DeSantis, for that fine opening statement as well. Thanks for the witnesses for showing up today on this chilly day in Washington, D.C. I represent northeastern Pennsylvania, a place where people rely on community banks for their banking needs. In fact, in 1 out of 5 counties in America, community banks are the exclusive source of credit. Individuals, homeowners, small business people, and farmers need community banks to be open for business in their communities. So protecting the sustained viability of community banks is important for the quality of life in small towns and rural counties all across this nation. But a long-term trend of consolidation in the banking industry threatens the continued existence of community banks. According to the FDIC, the decline in the number of banks with assets less than $100 million was large enough to account for all of the net decline in total banking charters between 1984 and 2011. At the same time, banks with assets over $10 billion have expanded their share of industry assets from 27% in 1984 to 80% in 2011. In fact, just 90 banks now control $11 trillion in assets in this country. We are still recovering from our national experience with the big banks that fail. The hearing today probes the extent to which the Wall Street Reform and Consumer Protection Act of 2010, also known as the Dodd-Frank Act, has contributed to this 30-year trend in bank consolidation. I hope today's hearing is not just another attempt by those opposed to reforming Wall Street and protecting consumers from predatory banking practices. Unfortunately, some of the folks across the aisle from me have devoted considerable effort to stymie the law's new protections. Until just days ago, Republicans in the Senate refused to consider President Obama's nominee to head the Consumer Financial Protection Board until the Dodd-Frank Act was amended to their liking. Members on this committee spent a week of hearings interrogating Elizabeth Warren, formerly the appointed head of the CFPB, who was trying to stand up the new agency. I wish that effort could have been spent interrogating the people who caused the financial crisis rather than the public servants who were trying to prevent the next one from occurring. What is clear from looking at the Dodd-Frank Act and its implementation so far is the real awareness by the law's authors and regulators of the dangers of banks that get too big and the importance of protecting small-sized community banks. In example after example, we have seen evidence that requirements imposed by the law specifically exempt small community banks, and the costs of new regulations are largely borne by the large banks. That is as it should be, and I think was the intention of the law's authors. Fortunately, today, we have with us former Congressman Brad Miller, who was our participant in drafting of the bill. If the intention to protect small community banks has not been fulfilled, I want to hear about that. That is the purpose of congressional oversight. But if the purpose of this hearing is to impede implementation of new consumer protections and to address the causes of the financial crisis, I strongly reject that. I look forward to hearing from the witnesses today, and again, I thank the Chairman and Congressman DeSantis for being here today. Thanks.
Thank the gentleman, and the gentleman from Tennessee would like to make an opening statement.
Well, very briefly, Mr. Chairman, thank you for requesting this hearing. I think this is a very important topic, and I will tell you that just a few weeks ago there was a column in the Washington Times which said that it's been 3 years since the House and Senate passed the Dodd-Frank financial reform legislation. So far, the effects are not what Washington promised. More than 200 smaller banks have failed in the wake of Dodd-Frank. And it says, and he said, we have learned once again that whenever Washington announces new regulations, hold on to your wallets. And very similar to that, I have a column by Louise Bennett from the Cato Institute, an article that appeared in the American Banker, and she said this, the Dodd-Frank Act sold to the public as the tamer of the Wall Street titans may well end up having a disproportionate impact on smaller institutions, thanks to the costs of capital implications being not too big to fail and the advent of the Consumer Financial Protection Bureau. And that's the problem. When you overregulate something, it hurts the little guys first, then the medium size, and it ends up helping the big giants. And I can tell you, I have no problems with the regulators being very strict, very tough on the big giants. But that's not the way this law is working, and I've had many bankers in my district in East Tennessee complain about this and tell about how expensive it's been for them already, and it's only going to get worse if we don't do something about it. So I thank you for calling this very important hearing.
Thank you. And the committee received a letter from the Credit Union National Association explaining how credit unions are similarly burdened by onerous regulations in Dodd-Frank. Like community banks, credit unions were similarly blameless for the financial crisis of 2008. And with unanimous consent, we will enter this letter that they sent to the committee into the record. Members may have 7 days to submit opening statements for the record. We will now recognize our panel. Mr. Eddie Creamer is President and CEO of Prosperity Bank of St. Augustine, Florida. Professor Tanya Marsh is Assistant Professor of Law at Wake Forest University School of Law. The Honorable Bradley Miller is a former member of Congress and Senior Fellow at the Center for American Progress. And Ms. Hester Pierce is Senior Research Fellow at the Mercatus Center at George Mason University. Pursuant to committee rules, all witnesses will be sworn in before they testify. Please stand. Where's that? Please rise and raise your right hand. Do you solemnly swear or affirm that the testimony you are about to give will be the truth, the whole truth, and nothing but the truth? Let the record reflect that the witness has answered in the affirmative. Yeah. Now, you'll each be recognized for 5 minutes. I know some of you prepared statements. You feel free to read from that or provide whatever information you'd like to provide. So, Mr. Creamer, you're up.
Thank you, Vice Chairman DeSantis and Ranking Member Cartwright, Ms. Duckworth, and Mr. Duncan. I appreciate this opportunity to speak to you today. It's both an honor and a privilege for me to talk to you on behalf of my 160 employees about the sometimes damaging but always overwhelming and ever-changing regulatory environment that a community bank faces. As my written testimony states, I've been a community banker in Florida for over 31 years. And while I understand that all banks must be regulated and the consumer must be protected, I also understand that these regulations must be clear, concise, uniformly applied to banks so they can reach their or meet their intended purpose. I also understand that the vast difference between community banks and very large banks, that a one-size-fits-all regulatory approach is impractical and frankly does not work. There's certainly more complexity and systemic risk in a $2 trillion bank than there is in my $748 million bank in Northeast Florida. Today's Wall Street Journal headline reporting that one of our country's largest banks will likely agree to a record fine for manipulating the electricity market is the best example I could give you of this difference today. Well, I do not understand how a bank could manipulate the electricity market, nor do I think I want to understand that. I do understand the crystal clear difference when contrasted to what a community bank does and the purpose it serves. Over my 31-year career, I've experienced law after law, regulation after regulation, rule after rule. FERIA, Gramm-Leach-Bliley, Truth in Lending, Truth in Savings, Fair Lending, Know Your Customer, and now Dodd-Frank. Dodd-Frank, by the way, which by some reports almost 63% is yet to be written, so I can't judge the impact of that. All of these regulations, while well-intended, had the stated purpose to protect, defend, amend, enforce, or simplify something. There are thousands and thousands of pages that a community banker must understand and attempt to comply with. And rarely, if ever, are existing regulations amended, repealed, or modernized in consideration of the new regulations. These laws and regulations and rules are often inconsistently interpreted and applied from exam to exam and examiner to examiner, and frankly from agency to agency. This has created regulatory fatigue in our bank and among our employees, and the cost of compliance with these regulations skyrocketing for us. You have seen in the written testimony here, and you already know, that community banks play a vital role in our economy. To continue to play this vital role, it is important that community banks have clear, concise, uniformly applied regulations commensurate to their business model and their inherent risk. If not, I am confident there will be fewer community banks. And if there are fewer community banks, there will be fewer choices for the consumer and fewer products. Fewer choices, fewer products mean higher cost for the consumer. Again, I'm deeply grateful for this opportunity to talk to you about my industry and my profession, of which I'm deeply passionate, and I welcome the opportunity to address your questions. Thank you.
Thank you for that statement. And the Chair will now recognize Ms. Pierce for her opening statement.
It's an honor to be here today. I appreciate the opportunity. One of the wonderful things about our financial system is its diversity, its flexibility, and the competition that it affords. And this is good for consumers because it allows consumers of all different types to find something that works for them. Unfortunately, the regulatory system that we're putting in place is not consistent with that competitiveness, flexibility, and diversity. Instead, it prefers large banks over small. It imposes regulatory costs that disproportionately burden the small banks, and its consumer protection model is one that works much better for large banks than it does for small. A lot of people say Dodd-Frank is not about community banks, it's about big financial institutions. And they're right. It's about a partnership between big financial institutions and the government. This manifests itself most directly in the designation of systemically important financial institutions under Dodd-Frank. And while it's true that as a designated institution, you are subject to many more regulations, but what is also true is that the government has made a statement that they stand behind those institutions, that they think they're too important to fail. And so when times of trouble come, when there's a liquidity crisis, customers of these institutions and also creditors are going to know that it's the large banks that the government has the back of the large banks. And that's a real advantage for large banks. But there are also more subtle disadvantages for the smaller entities, and that comes in the form of regulatory burden. The financial industry was, as we just heard, quite regulated before Dodd-Frank, but Dodd-Frank came along with almost 1,000 pages of legislative text, and then add to that 11,000 pages and counting of proposals and final rules and guidance. For a large bank with an army of in-house lawyers, outside experts to assist them in figuring out how to comply and how to comply efficiently, it's a burden, but it's not the type of burden that it is for a community bank. For a community bank that has to hire a new compliance person or pay high-priced outside consultants to help it understand what applies to them, it could be the difference between a profitable year and not a profitable year. But more important, I think, than the monetary cost is the distraction. If you think of your average community banker who got to where she is because she loved the community she serves and she wanted to figure out how to help small businesses in that community grow, how to help families buy homes, she didn't want to spend her time thinking about regulation. But now the cloud of uncertainty, of regulatory uncertainty, is what's keeping her up at night. And that's not good for the consumers that she wants to serve. And then as far as consumer protection goes, the Dodd-Frank model of consumer protection is one in which the regulators in Washington will figure out what works best for consumers all across the nation, and that means designing plain vanilla products that will work for every consumer in every circumstance. And that works pretty well for large banks, which have a mechanistic approach to lending. But for a community bank, which prides itself on getting to know its customers and its communities and tailoring products to them, it doesn't work so well. And so this could end up leading community banks into areas that they're not, into new business lines that they're not comfortable with, into new products, and into more aggressive ways to fund themselves and more aggressive product lines. So what can we do about this? Well, first we can find out more. We can find out what the good, the bad, and the indifferent parts of Dodd-Frank are for community banks, which the Mercatus Center, where I work, is now trying to do that. We're conducting an online survey of small bankers, and we hope to present the information that we get from that to policymakers so that they can figure out which parts are truly the worst. And the second thing that we can do is now we have 3 years of objective hindsight with which we can look at Dodd-Frank and say, okay, what's working and what's not? What do we need to fix? What do we need to throw out? And then we can look at designing better exemptions for small entities. And these exemptions can't be ones that are conditioned on very complicated criteria, because then that too becomes a regulatory burden for the small banks. And then we can ask the regulators, ask the financial regulators to do economic analysis. This is something that they don't traditionally do, but it's not too much to ask them to look through an economic lens, figure out what the problem they're trying to solve is, look at the alternatives, and look at the costs and benefits of those alternatives. Thank you very much, and I'd be happy to answer any questions.
Appreciate that statement. Mr. Miller, thank you for joining us. You're up for 5 minutes.
Thank you, Mr. Chairman. I'm Brad Miller. I've served for a decade as a member of the House and left at the beginning of the year. I'm now of counsel to the law firm of Grayson Ellsworth and a senior fellow at the Center for American Progress. The consolidation of the banking industry has largely reduced the role of community banks to a niche in the economy, but it is an important niche, as almost everyone who has spoken has noted. Community banks still hold a majority of deposits in rural and small-town America. 1 out of 5 rural and micropolitan counties, that's small towns. The only physical banking offices are those of community banks. Community banks are locally owned and controlled. They gather deposits locally, and they make lending decisions locally. As of 2011, 46% of the banking industry's small loans to farms and businesses were by community banks, and community banks just had 14% of banking assets. Congress and regulators should recognize real differences between community banks and too-big-to-fail institutions. Avoid needless compliance cost, because compliance costs are largely a fixed cost rather than a variable cost. Avoid giving large institutions an unfair competitive advantage. Allowing examination of smaller banks for CFPB compliance by existing safety and soundness regulators rather than having too disruptive regulations is a sensible recognition of the differences between community banks and bigger banks. I got some grief at the time from some of my usual allies on financial reform for leading that compromise, but I thought then, and I still think, that different compliance examination rules made sense. Similarly, the CFPB created a sensible, limited exception from the qualified mortgage, or QM, rule for portfolio mortgages by community banks and credit unions with less than $2 billion in assets that make fewer than 500 first lien mortgages a year. The Dodd-Frank Act was the most significant set of financial reforms since the New Deal. And the financial crisis was the most significant financial crisis since the Great Depression. A GAO study last fall concluded that some provisions will help community banks, such as supervision by the CFPB of non-bank lenders that competed unfairly with responsible community banks in the past, and changes in the calculation of deposit insurance premiums. Other provisions inevitably will result in some compliance costs for community banks, the GAO found. But how much will depend upon the implementing regulations. So this is all kind of a guess in what compliance costs may be. Regulators should certainly make sensible exceptions, like CFPB's exemption from the QM rule for some portfolio mortgages by community banks. But other provisions really should apply equally to all lenders. Community bank lending may be more relationship-based than lending by bigger banks, but no one walks into a community bank with a legal pad or a laptop and says, I need a loan. Do you want to be the party of the first part, or do you want me to be the party of the first part? They all use standard forms. They use the same forms for all of their lending. No lender's standard form should include predatory equity stripping provisions. Community banks were generally not guilty of some of the worst abuses of the last decade, and community banks remain more constrained by reputational concerns than are the biggest banks. But community banks are not incapable of bad conduct. In the movie It's a Wonderful Life, George Bailey was a community banker, but so was Mr. Potter. I know that I've just made a reference that no one under the age of 30 caught, which means 97% of congressional staffers. There is litigation pending now against a New York community bank for mortgages that the banks made to homeowners with lots of equity but problem credit. The mortgages had an interest rate that adjusted to almost 10%. If a homeowner was late with a payment, the rate went to 18% and stayed at 18% until the homeowner got completely current. Almost half of the 5,000 mortgages, 5,000 homeowners who got those mortgages are losing their home. If Congress is serious about helping community banks compete, there are a lot of things Congress can do. Congress can limit ATM charges that are unrelated to the cost of transactions. There's a Bank of America cash machine just 2 blocks from here on Pennsylvania Avenue. Good luck with finding one for Prosperity Bank. Most important, Congress should end the implicit subsidy of too-big-to-fail banks. The ICBA has joined in the chorus calling for ending too-big-to-fail because of the unfair competitive advantage it gives too-big-to-fail banks over community banks, and Congress should pay attention. Again, Mr. Chairman, thank you for this opportunity to testify.
Thank you for your attendance, and Ms. Marsh, thank you for attending as well, and you're up for 5 minutes.
Thank you, Chairman, members of the subcommittee. I appreciate you convening this hearing today and for inviting me to testify. My name is Tanya Marsh. I'm an associate professor at the Wake Forest University School of Law in Winston-Salem, North Carolina, and I'm an adjunct scholar at the American Enterprise Institute. In May, I co-authored a research paper for AEI entitled The Impact of Dodd-Frank on Community Banks. A copy of that paper is included in my written testimony, but I just wanted to highlight a couple of key points from it for you today. The purpose of Dodd-Frank, as everyone has noted, is to prevent another financial crisis by enhancing consumer protection and ending the era of too big to fail. But the regulatory burden imposed by Dodd-Frank on community banks, I believe, undermines both goals. And ultimately, it will harm both consumers and the economy by first, forcing community banks to consolidate or go out of business, furthering the concentration of assets in too big to fail institutions. And second, encouraging standardization of financial products, which potentially will leave millions of vulnerable borrowers without meaningful access to credit or banking services. The American system of banking regulation is really a system of regulation by accretion. And what I mean by that is it's a result of about 200 years of very well-meaning legislative responses to financial and banking crises. But the net effect of all of these policies is a one-size-fits-all system that is fundamentally flawed. My key message today is I think we need to take a step back and rethink our regulatory approach to banking in general, to target our resources on the real risks to the American consumer and the American economy, rather than doubling down on a regulatory approach that represents more of a historical accident than a deliberate policy choice. It's a simple fact that a depository institution with $165 million in assets, the median American bank, poses different risks to consumers and the economy than a $2 trillion bank, and I think we should take a more tailored approach to regulating them both. We need to remember that financial services sector is not a free market. It's a highly regulated market. Therefore, our policy choices can have a substantial impact on the ability of institutions to compete within that market. Although few would argue, and no one is arguing here today, that community banks caused the financial crisis, 7 of the 16 titles of Dodd-Frank are expected to impact community banks in some way. Hundreds of regulations are anticipated to be promulgated. Most of these rules are very complex, and the stakes for understanding and following them are high. It is not an insignificant cost to have an expert read the new regulations as they're proposed and determine whether or not they are applicable, let alone implement them. As the Federal Reserve determined in 1998, a small bank is less able to absorb this regulatory burden than a large bank. So by imposing unnecessary regulation on smaller institutions, we are awarding the larger banks a further competitive advantage. A recurring theme in Dodd-Frank, particularly with respect to the Consumer Financial Protection Bureau, is that the standardization of financial products and forms will protect consumers. But this focus on standardization fails to recognize the challenges posed by borrowers who lack the deep credit history or documentation necessary for the model-based lending that's used by the larger banks. The self-employed, seasonal workers, farmers, people transitioning to work are particularly at risk, I believe, by increased standardization. Financial activities that are fundamental to the average American are only really worth the time of a mega bank if they involve a completely standardized product and if the borrower is a completely standardized borrower. You either fit in the box or you don't. And as a result, millions of Americans are left out of the box altogether. According to the FDIC, 1 in 4 American households is unbanked or underbanked. These households interact with non-bank financial service providers who have been largely unregulated prior to Dodd-Frank, and they typically bear far higher costs than those households that are fully served by banks. So if regulators push the entire banking industry in lockstep towards standardization, many small businesses and individuals that are currently served by community banks may be denied credit and swell the ranks of the unbanked or underbanked. In addition, because of their higher operating costs relative to larger banks, If community banks become forced through standardization into just small versions of large financial institutions, they will be at a severe competitive disadvantage. So as a result, credit and banking services will be eliminated or become more expensive for millions of American consumers, especially those living in rural communities and small businesses. For these reasons, I asked the subcommittee to consider taking an overall fresh look at the federal regulation of banks to determine how to more appropriately regulate both community banks and large financial institutions. Thank you again for the opportunity to testify today.
Well, thank you for your statement and for your attendance, and Chair will recognize himself for the first 5 minutes of questions. You know, it's interesting, I saw an estimate about once all the Dodd-Frank rules are implemented that compliance economy-wide is going to be about 24 million man-hours. And by way of comparison, 20 million man-hours was sufficient to build the Panama Canal. So this is a huge diversion of energy into compliance. And I think today we want to figure out, is all this compliance necessarily a good thing, particularly for institutions who are not too big to fail and did not cause the financial crisis. Mr. Creamer, do you have unlimited resources at your bank?
No, sir, I do not.
So as you face more burdens from the regulatory apparatus, do you basically have to just divert existing resources into meeting that the compliance requirements?
We divert existing resources. In addition to that, over the past 4 years in a very difficult economy when, as a small business, a bank or any other business had to watch every cost, every paperclip, every piece of paper to make sure that we retain the core profitability that we needed to survive. Those limited resources were strained even further as we moved away from customer-facing personnel to compliance and audit-related personnel. In fact, coming out of the recession now, I went into the recession with 260 employees. I came out of the recession with 165 employees. I now have more compliance staff than I do small business lenders.
And does that have, I would imagine that would have an effect on how broad you can lend throughout the community, given those numbers?
It has a negative effect. Obviously, first of all, during the recession, there was not a lot of demand for new loans, but there was a lot of demand from existing customers for help with existing loans. As we've seen in Northeast Florida now, the economy's begin to recover, and there is a demand for new loans, but resources are still limited. And so having the compliance and audit staff and the costs we spend in addition to that for training and 3 outside firms we employ for compliance review, it will cost us in excess of $750,000 this year just for compliance. That's resources that I cannot devote back into production people, calling officers, and that sort of thing.
Now, just as a experienced community banker, does your bank or any community bank that you've seen pose a systemic risk to the national or world economy?
I don't believe we pose a systemic risk to the national or world economy. In fact, I'm not sure we pose a systemic risk to St. Augustine and Palatka, frankly. We perform a very important function in those markets. But I do not believe the economy would stop functioning if we cease to exist.
Now, I guess one of the, Mr. Miller suggested, hey, well, you can cap some fees or do this. Now, you and I talked in the district about some of the purported consumer protection regulations that come out, and you serve a lot of low-income people, and you told me the issue you're having with some of the folks who have this overdraft protection and how you're basically in response to the regulation that's supposed to be pro-consumer, they're now actually going to probably have less choices. Can you explain that?
Well, we are a business like most other businesses. We are a for-profit business. In fact, our regulators want to make sure we are a for-profit business because, obviously, one of the ways we build capital, which is very important, is through our net profit. When our profit is strained or our costs are increased, we have to pass that on to some extent to the consumer. We can only cut costs so much within our organization. And I think more specifically what you and I talked about was in relation to the overdraft protections. We serve a very blue-collar market. In fact, to a large extent, we serve a what I call a no-collar market. A lot of contractors, a lot of people who are working for a living. There is a misconception about banks and overdrafts. Customers who use overdrafts are normally not customers that are being abused by the financial institution. They are using those because they're making a conscious choice, because it's 2 days before payday and I'm a school teacher or I work for the city and I have to pay my rent or I have to buy my groceries. That's a fact of life in our economy. I have two choices. I can write a check that I know my bank's going to pay, which has very little stigma to me, and I will cover that check later. Or I can go to the payday lender, which has a huge stigma and a large cost to the consumer. So in many cases, what is represented as being terribly problematic is more so serving a demand for that individual customer that is making a choice.
And, as a result of some of the new rules, you basically are going to be in a situation where they're going to have less options in that respect?
They already have significantly less options.
Okay. Ms. Pierce, you kind of hit on this, but with the advantages that some of the heavy regulatory burden provides to some of the large banks, obviously they can comply with this much easier. They have huge staffs, all this. Are there funding costs? And you said there's an implicit taxpayer guarantee here. So does that reflect itself in them having lower funding costs than small and medium-sized competitors?
I think it does. Now, they don't always compete in the same capital markets, the small banks and the bigger banks. But I will say that especially during a time of crisis, we're going to see that funding gap really spread. And that's when it really matters, when you need to have liquidity to survive. It's going to really matter, and the bigger institutions will have a hands-down advantage then. So I do believe they have a funding advantage now, but it's even more critical in times of crisis.
Great, thank you. My time has expired, and I will recognize the gentlewoman from Illinois.
Thank you, Mr. Chairman. Thank you to all the witnesses for being here. I'm deeply concerned about the well-being of our community banks. I feel that they're absolutely critical to the success and economic well-being of our communities. They provide close to half of the small business loans, at least in my district, and I think that may be nationwide. And they also provide something around a 16 to 20% range of residential mortgages, mortgage lending. Community banks operate on a very different business model than the large banks, and I think it's really critical that we ensure that any financial regulations that we put into place respect those differences and don't put our community banks at a disadvantage. The last thing I want is more consolidation in the market and for the too big to fail banks to get even bigger. The housing market in Illinois was particularly hard hit, and as it recovers, I want to make sure that we are not harming the ability of families in my state to achieve the American dream of buying a home. The CFPB has requested public comments on the proposal to adjust the qualified mortgage rules for the community banks. Could each of you provide me with your thoughts on the impact of this proposed adjustment to the qualified mortgage rule will have on residential mortgages, residential mortgage lending, particularly for community banks?
Yes, ma'am, and thank you. I can speak from my standpoint. I'm not comfortable with the CFPB defining a qualified mortgage. Okay. I think that's the purview of the bank and its underwriting practices and the customer individually at the time. As an example, the definition now, as I understand it, is if a mortgage loan is made in excess of a 90% loan to value, it may not be a qualified mortgage, and the borrower could have a rebuttable presumption to put the loan back if there's a default. Unfortunately, in our market, that will have the effect of eliminating a huge segment of needed mortgage loans. I know a number of people, and I will speak for my son and my daughter-in-law, who are both college graduates, who are both gainfully employed, who are both renting an apartment. And at some point, they'll want to buy a home. And in our market, to buy an affordable home, it would probably be $175,000, and there'll be closing costs in that. For them to put 20% down in that home would probably be somewhere around $40,000. Well, not only do they not have $40,000 saved, they haven't sold a home and made $40,000. Most Americans have a hard time saving $40,000. And even though they would fully qualify for the loan, they would be prohibited from getting the loan because of the down payment requirement, even though the monthly payment at today's interest rates would be less than their rent payment.
Great point. Ms. Pierce?
Yeah, I mean, I just want to echo what Mr. Creamer said in the sense that it should be the bank's responsibility to figure out what sound underwriting is for a loan. It's very difficult to, I think the CFPB has a very difficult task to try to set underwriting requirements for all the loans across the country, and that's really what they're trying to do in the qualified mortgage rulemaking. And there are exceptions, but the exceptions, from my understanding, aren't broad enough to cover some of the normal lending practices of community banks.
Congressman Miller.
I understood your question about QRM rather than QM. One of the criticisms that we heard of what went wrong before the financial crisis, leading up to the financial crisis, was that the origination of mortgages was a originate to distribute, and the originator, which were often not community banks, were often mortgage companies with essentially no assets, sold those immediately to Wall Street, which immediately put them in a pool and sold mortgage-backed securities based upon them. And so the phrase we used, or we heard so much at the time, was skin in the game. That if the originator had some skin in the game, they would in fact apply underwriting standards, but if they could get somebody to buy 100% of the risk, they didn't care. So the object of qualified, but then the idea was they had to keep at least 5%. But we heard from a lot in the financial industry that if we did that, it really would constrict liquidity, and there should be some kind of obviously safe mortgages that should not be subject to that 5% retained risk, skin in the game requirement. Now, I have thought that the QRM rules do go too far. I don't think that we need to go back to Ozzie and Harriet loans of the 1960s. I don't think we need to have 20% prime, all the rest. But I do think that as an exception to the risk retention rules, the QRM, a QRM exception does make sense. And leaving it entirely to the banks just puts us back where we were in the middle part of the last decade.
I'm out of time, Mr. Chairman.
Ms. Marsh, if you want to weigh in on that,
If I could just briefly, I think that the qualified mortgage rule is a great example of the standardization issue that I mentioned in my testimony. So when I was doing research for my paper, I talked to a community banker in the upper Midwest, where the economy is very reliant on timber and mining, seasonal activities. So most people don't have any cash flow during the winter months. He structures residential mortgages so they only have to make payments for 9 out of the 12 months because that matches their income stream. Under the qualified mortgage rules, you can't do that. That's not the kind of activity that we're trying to clamp down on. We're trying to align underwriting risk with skin in the game, as Congressman Miller mentioned. And I think exempting loans that are held in portfolio can accomplish that.
Thank you. The chair now recognizes the gentleman from Tennessee.
Loans held in portfolio are 100% skin in the game.
Right.
Okay.
Well, thank you, Mr. Chairman. The staff, I asked, I didn't know what the up-to-date statistics were, so I asked the staff a few minutes ago, what was the average size of a typical bank in this country, and they tell me the median size, bank size, is $165 million, that 80% of the 7,100 banks have less than $1 billion. The average size of the 10 largest banks is $717 billion, and so there's quite a discrepancy between the very largest. And I started this hearing saying that, I don't have any objection to going to these trillion-dollar banks or these mega-billion-dollar banks because they can handle it. But the problem is that this is those quotes I gave, this is most harmful to the little banks. In fact, this one article says, thanks to Dodd-Frank, community banks are too small to survive. We talk about too big to fail, too small to survive is what we're looking at, and the over 200 that's run out of business since we started Dodd-Frank. And Ms. Pierce, I was under the impression, I remember every member gets a thing called the Congress Daily at their door each morning. And I remember 2 or 3 years ago, there was a cartoon in there, and it showed these banks with huge bags full of money, and the bankers saying, lend, and I mean, excuse me, and it showed the President Obama, saying lend, lend, and then it showed the regulators pulling back, saying no, no, no. And I was under the impression that the banking industry, even before Dodd-Frank, was one of the more heavily regulated industries in this, or businesses in this country. Is that correct? I mean, before you had the 2,300-page Dodd-Frank law and the hundreds of new rules and regulations, you already had all kinds of rules and regulations and red tape for these banks anyway.
That's correct, and unfortunately, some of those rules directed bankers to, instead of using their own skills and figuring out whether to loan and when, it tried to direct them when to loan and tried to make decisions for them, just as you mentioned.
Mr. Creamer, did you start your bank, or were you in at the first?
No, sir, I did not.
What size was it when you first got
When I
involved?
joined Prosperity Bank in 16 years ago, the bank was about $75 million in assets.
75 million.
Yes, sir.
What do you think would be the effect on a bank much smaller than yours? Let's say $100 or $200 million bank.
Of a regulation, of the current regulation?
Yes, of the Dodd-Frank law.
Catastrophic.
Catastrophic.
Yeah, because resources are resources. Banks operate on net interest margin and non-interest income. Both of those are a function of asset size. The larger the bank, especially in a community bank that gets over $500 million, and there's been a lot of conversation that if you're not over $500 million, you probably can't afford to operate in the regulatory scheme. But economies of scale build in, and you have some efficiencies at that point to afford compliance staff. And at some point outside legal help. If you're below that level with net interest margins compressed as they are today and non-interest income being regulated down as hard as it is today, it's going to be extremely difficult for those banks to, one, I would say survive, and I don't mean survive from a failure standpoint, I mean without having to merge out, and two, to be profitable to return any modicum of return to the shareholders.
Do you think, Ms. Marsh, do you think that this law is going to continue this trend of forcing smaller banks either out of business or forced to merge with bigger banks?
Absolutely, it already has, actually. I think Ms. Pierce and I have both conducted or are conducting research to try and quantify what the regulatory burden actually costs banks and to see what actually happens as a result. It's very difficult to figure that out, especially since many of the rules are still being created. But there's all kinds of anecdotal evidence that small banks are merging. And if you listen to the testimony and the public statements of the leaders of some of those banks, they're doing it because, as Mr. Creamer mentioned, a smaller bank simply can't absorb the costs, and they have to bind together to survive collectively.
Well, I just think it's very sad that a law that was aimed at a few big giants on Wall Street is ending up hurting the little guys and the medium-sized guys most of all. Thank you very much, Mr. Chairman.
Thank you, and Chair will now recognize the ranking member of the full committee, Mr. Cummings.
Thank you very much, Mr. Chairman. And I want to thank all of you for being here, and to Congressman Miller, it's good to see you back. I always respected your work in so many areas, but particularly in this area. Many of the provisions under the Dodd-Frank Act are geared towards the larger, too big to fail institutions. However, there are many examples where community banks receive positive treatment under new regulatory requirements implementing the Dodd-Frank Act. For example, the Dodd-Frank Act raised the federal deposit insurance coverage on consumer bank accounts to $250,000 while shifting the cost to larger institutions to better reflect their industry market share. Community banks have benefited by a significant drop in federal deposit insurance premiums paid by the institutions, with less than $10 billion, and it was recently announced that there will be a refund of $5.8 billion in deposit insurance fund prepayments from the last 3 years. Congressman Miller, by reforming the deposit insurance assessments, do you think that the regulators have the right balance in terms of assessments charged to large banks versus the small banks?
But Mr. Cummings, I think we did that. We should. We don't want to give the regulators credit for that.
Okay. All right.
But
Well, we'll take credit.
I know that Mr. Kramer, in his written testimony at least, did speak of the burden of deposit insurance, the assessments of the premiums, but the adjustment of those was something that truly does help. The GAO study pointed to that as something that would truly help community banks. The fact that community banks were having to compete with non-bank lenders that were not playing by any rules at all was unfair to community banks, took away business. That is something else that helps community banks. And the GAO study said, as for the rest, it's certainly true that we've passed the most significant financial reform package since the New Deal because we had the most significant financial crisis since the Great Depression. So, of course, there will be some compliance costs, but until the implementing regulations come down, we can't know what they will be. So all of what we've heard about how crushing they will be is speculation because we don't know, because most of them have not come down. The CFPB, at least, in their rulemaking to this point, has taken to heart the suggestions of small banks. They have a trade association, Independent Community Bankers Association, ICBA, that has been very involved in rulemaking. The reformers, like Center for Responsible Lending, CRL, is working closely with ICBA and trying to be reasonable and compromise. As I said in my as I said both in my oral statement and my written statement, I very much encourage the regulators to look closely at the concerns raised by community bankers, to see what is not a necessary cost of compliance, as we did in Congress with having a different examination regime for the CFPB for small banks, and try to make sense of this, not needlessly drive up compliance costs, but also recognize where the rules do need to be the same.
Okay. The Dodd-Frank provides the CFPB with supervisory authority over non-bank financial institutions in a capacity new to that industry. Congressman Miller, in your testimony today, you stated, and I quote, a GAO study last fall concluded that some provisions will help community banks, such as the supervision by the CFPB of certain non-bank lenders that competed unfairly with responsible community banks in the past. Would you comment on that, please?
Certainly. There were some, like the New York Community Bank I spoke about in my testimony, my prepared testimony. There are some bad actors, but generally the community banks were not guilty of the worst practices. Some of the worst practices were by mortgage companies that were not depository institutions at all, did not have a charter from anybody. They were almost completely unregulated. I've heard Ben Bernanke say, in sort of defense of the Fed, and that because they had rulemaking authority they never used under HOPA, Home Ownership and Equity Protection Act, passed in 1994, that the mortgage market, mortgage practices went to hell in a very short period of time in a pretty dark part of the market where they did not really see what was going on. You certainly had lenders like Ameriquest that weren't depository institutions at all. You also had really a gray line between brokers and an originator that all you really needed to do to become a mortgage company was to get a warehouse line of credit and to have a relationship with a Wall Street investment bank that would buy the mortgages as soon as you made them. And those folks were competing with Mr. Kramer. And when you make them play by the same rules that Mr. Kramer plays by, that his bank plays by, it's going to help him a lot.
Thank the gentleman, and the chair now recognizes the gentleman from Georgia, Mr. Collins.
As we go forward, you made a comment earlier, and you made a statement, what was your?
Micropolitan is a Census Bureau term. It just means small towns.
Well, I have another term for it. It's called home. And
It was called my district, too, yes.
Exactly. So we understand it, and I think it sort of sets the stage for my questions, and it's really where I'm at as well. Because I like your analogy, and by the way, it's a traditional favorite at our house of the Baileys and the Potters, and we understand that. And I think
You're raising your children right.
exactly right. We see it. But I think there is an issue of the market taking care of the Potters of the world, and there is an issue with the Baileys, and neither one were exactly models of bookkeeping, okay, in that movie. But what I see here, and what I want to talk about, Mr. Creamer, is I see you here today, and I sense as we're talking about this, I just sense a frustration, not in necessarily your voice, but in your eyes. That you're just, as you see, you look a lot like the bankers that I talked to in Northeast Georgia. One of the stories that I have, and it may be similar in your area of North Florida, was we had a community bank, a little 3-branch community bank, great little lender. Came in with all the regulations. They came in with their auditors came in to their home office. Their home office had 10 employees. They brought in about 14 auditors and got mad because they didn't have a place to work out of. This is the kind of things that I think folks just don't understand. Mr. Kramer, are you seeing this sort of thing as you talk to other bankers? I'd like just to hear, I've read your statement, and I'm sensing that, but I also want to hear from you again.
Well, I'd like to apologize first for speaking with my eyes and not my voice.
But I think it's what this happens.
There is a large level of frustration, and I had breakfast with my vice chairman last week, and he told me I was becoming cynical, and I need to guard against that. So I am guarding against that.
Well, you came to the wrong city for that.
Yeah. Well, you know, I would first like to say I was remiss in not thanking the members for speaking very complimentary about community banks and even the testimony here, and saying a number of times that we did not cause the financial crisis, because frankly, if you've been on the business end of 8 safety and soundness exams over the last 6 years like I have, you would believe that you are the sole cause of the crisis. It is comforting that the FDIC is going to give back some of the premiums. However, in the state of Florida, there's about 200 community banks, plus or minus. 75 of those were put under consent or cease and desist orders over the past 4 years. Mm-hmm. Of those 75 cease and desist orders, 63 read exactly the same, and they all impose 8% and 12% capital ratios, which are above the regulatory standards. If you have one of those consent orders, you do not get a refund of that premium, so it is not very helpful in that. From the examination story, in our bank, it's more like 30 to 35 examiners. It is a 6 to 8 week process. That is new in the last 4 years, and it's, I mean, it's something we have to do because we're in an insured institution. But it is difficult at best.
And one of the things I want to emphasize in my little bit of time I have left here is Georgia has had a large issue with that problem as well. Failed banks and failed specifically community banks for a number of reasons, some good and some bad. But one of the issues that I'm having trouble as we get around just some issues that my banks are bringing to me was not being able to get into the markets, the de novo standard, the coming out in 2008, where well-capitalized are limited. If they were established after 2008, that standard coming in where they can't reach out into markets in a different way. Can you explain, and Mr. Kramer or others want to jump in, explain the change in de novo status is meant for newer community banks trying to come in and fill the gap where some have been mentioned? And also, has there been effect of this standard maybe cutting back the access to residential mortgage markets in areas that are effectively preventing healthy community banks from entering into those markets? Is that something that you would speak to or someone else would speak to?
I'm not sure I can speak to the de novo situation because we're not a de novo, and I can't imagine anybody would want to start a bank today anyway.
Yeah, we've had a couple, and I have one bank in particular that was starting to get into a new market, had hired consultants, went through the paperwork, and went through everything else. The consultants then went to another job because of the length of time it was taking to get this up, so they finally just put it on hold, and it stopped the market. And it was just, again, we're in an area which is a little bit different, so anybody else want to take a stab at it, Congressman, and others? I mean, because it seems like we're limiting our environment here, and that's the one thing we really don't want to do, as long as the standards are properly and appropriately applied.
I'm not familiar with any, like Mr. Creamer, I'm really hearing for the first time about a discussion about newly chartered banks. I think it's probably true there are not a whole lot. Now, there has been a study of the 200 or 300 community banks that failed during the financial crisis. I think it was the GAO, it may have been the FDIC, but in fact, most of those were fairly newly chartered banks. And they were fairly newly chartered banks that were chartered specifically to get involved in what they called at the time the real estate boom, now we call the real estate bubble. And that doesn't even take into account, it's like 70 or 80% of the failed banks were newly chartered banks that their business model was largely dirt lending, either acquisition, development, and construction loans, a form of commercial lending, or mortgages. And those were the ones that got into trouble. And then in addition to that, there were a fair number of investors who bought community banks specifically to get in on the real estate boom, now we call the bubble, and a lot of those got into trouble as well. But it's probably pretty hard to raise capital right now, in part because the economy is still kind of bad.
Well, and especially in those existing, Mr. Chairman, I know my time is out, but I think one of this is the thing that they are actors, and I do like the analogy to a point, the Bailey and Pottery situation, but we can't continue to regulate the Potters of the world at the expense of the Baileys of the world. And I think that's the problem that I'm seeing right now, and it's the concern that I have. Mr. Chairman, I yield back.
Thank the gentleman from Georgia. Now, we don't have anyone from the other side. Obviously, if they come, they'll be recognized. But seeing the lack of members on that side, the chair will now recognize the gentlelady from Wyoming.
Thank you, Mr. Chairman. Kind of following in on this theme, I'm from Wyoming, the smallest population in the nation. There really are no big banks in Wyoming, none. We're completely reliant on community banks, and so the thought that we'd all have to drive to Denver or Salt Lake or to bank for an entire state is absurd. Professor Marsh, I want to ask you, does too big to fail give systemically important institutions an advantage that community banks can't get?
Well, to clarify, what do you mean by too big to fail? So do you mean
Systemically
significant designation?
Yes.
That hasn't really been my focus of my research, but there are a number of people who would argue that that's true. I think it is true that that designation means that many people in the marketplace consider that the government, even though Dodd-Frank repeatedly says we're not bailing anyone out, the marketplace doesn't believe it. And the marketplace is giving a premium to the larger banks at the expense of the smaller banks. So
why doesn't the marketplace believe it?
I think because if you allow an institution to remain that large, if we found it difficult to imagine a world where they all cascaded in failure 5 years ago, and they've only gotten bigger since then, how can we imagine a world where the government would allow them to all cascade in failure this time?
Mr. Creamer, why doesn't your bank believe it?
Because it's been the practice that too big to fail, whether you are a financial institution or an automobile manufacturer, it has just been a practice that you've been bailed out. The moral hazard has been created. And as a financial person, we fully understand that a $2.3 trillion financial institution that can manipulate the electricity market cannot be allowed to fail.
So how is this going to affect the needs of customers in states like mine and communities like Mr. Collins in northern Georgia, very rural areas? What are we going to do?
Well, as Mr. Miller said earlier, and he's accurate on residential loans, that all the forms are basically the same. Not so on small business loans where the forms can be different. But the difference is the customers are not all the same. And in a community bank, it's about the story of the customer. It's about the need of the customer, what the customer is trying to accomplish, and how can the community bank help that customer accomplish what they're trying to accomplish. Because if we're successful in helping a small business owner accomplish what they want to accomplish, then they hire more people. More people potentially bank with us. More people then potentially borrow for their homes and their cars, which makes our community stronger and makes our bank stronger, and it's just a good thing.
So how many Fortune 500 companies do you think are incorporated in Wyoming, have their home offices in Wyoming? What would you guess? Anybody?
None.
You got it. So with places like Wyoming or any of these districts that are really comprised of small towns, what is the future for the borrower, for the small business person? The small business person.
The future should be a strong, viable community banking system.
How do we get it back?
We have to relieve the overwhelming regulatory burden off of the community banks, and we have to allow community banks to be able to effectively compete in the niches they compete in.
Professor Marrs, and you can answer that as well, but in addition, would you answer this question? Will the regulations coming out of Dodd-Frank make smaller banks more or less able to compete with larger banking institutions?
Well, I'll answer both questions at once, if I may.
That'd be great.
Because I think that, as I've said before and others have said, the issue is not to look at Dodd-Frank in a vacuum, because no bank can look at Dodd-Frank in a vacuum. It's regulation by accretion. So it's on top of decades and decades and decades of regulations that the banks have to deal with. And so that's our problem, right, that we just react to crises and add new laws. And what we need to do is take a step back and fundamentally reimagine what is the appropriate way to regulate a bank that is located in rural Wyoming, and most of its business is farm lending.
And the community banks, did they create this crisis that Dodd-Frank was built to address?
I do not think so.
I yield back, Mr. Chairman.
Thank you for that. I'm going to go ahead and do a second round. We may have some Democratic members coming. I did see just on kind of some of the news that I know Mr. Cartwright is down there for our IRS hearing, so that should give him a chance to come back up here. In terms of just the cause of the financial crisis, and I know you got to it a little bit in your report, but there was a narrative developed that it's Wall Street decided they got greedy and they tanked the whole economy, and I have no problem with criticism directed at Wall Street, but it seems to me that really overlooks the extent to which government policy created incentives that created the environment to where you would have that. So is that something that you would agree with just in your research?
I very deliberately stayed away from researching that. Well, I mean, I am much more interested in what the impact is, because from the perspective of what I was trying to write about, I don't care what caused the financial crisis. I care what's going to cause the next financial crisis and what's going to cause problems for small businesses and farmers and rural communities. Rural communities, I think, are the most vulnerable to this increased pressure on the small banks, and you didn't hear about a lot of problems in rural communities in the lead up to the financial crisis.
Sure. Ms. Pierce, do you have anything on that? Because it just seems to me that, and I wasn't in Congress during this is my first term, but it seems to me that people here are quick to try to say, oh, it was this, but not very quick to do a little self-examination in terms of bad policies that have helped create some of these problems.
Yeah, I mean, I think that institutions will take advantage of bad policies to work for their own advantage, and unfortunately, the government has set up a regulatory regime that really takes away consequences for poor decisions made by people in the private sector. And so what we need to do, and what we should have done instead of doing what Dodd-Frank did, we should have put more responsibility on the people who actually make bad decisions to pay for them. And I think community bankers will pay for their bad decisions because they're going to go out of business if they make a lot of bad lending decisions. But these bigger banks, we let them stay in business even though they continue to make very bad decisions. So yes, there's definitely a role of government policy.
So shifting the risk from taxpayers to shareholders, basically, you think that would be good policy? It
would be good policy, and making creditors responsible too, because they should be monitoring the institutions to which they lend.
When I walk around here, I'll get people bringing me these leaflets or whatever, and every week for sure, but sometimes even every day, someone will come up and, Glass-Steagall. Do you, Mr. Miller, Ms. Pierce, anyone, that repeal of Glass-Steagall, it's kind of a simplistic narrative that Glass-Steagall's repealed and then, lo and behold, the economy cratered. What role do you think that had in the financial crisis?
I think the deregulation generally in the 80s and 90s played a very large role. The separation of commercial investment banking, or the ending of that separation, at least had the role of making the institutions very large and very complex, and therefore too big to fail. The problem with too big to fail, the reason that it's a problem for community banks is that there is an assumption in the market, which I think Ms. Pierce talked about generally, or someone talked about the assumption. The assumption is that they will not be allowed to fail, so if you lend them money, you're going to get paid back one way or the other. If they can't pay you back, then the taxpayers will one way or the other pay you back, so you're going to get paid back. And that's worth something. There have been various estimates. Bloomberg, I think, estimated that it's 1/4 to 0.5% advantage. The rating agencies point to that to give better credit ratings to big banks, the assumption that they would not be allowed to fail. They're almost impossible to underwrite. They're too big. They're too big to fail, too big to manage, too big for the market to discipline, too big to underwrite. And so they're getting at least 0.5 point less when they borrow money than Mr. Creamer's bank does. ICBA is now very much on the issue of too big to fail. And their issue is that they get money more cheaply. There's a GAO study coming on it, I think shortly, if it hasn't already come out, but on too big to fail. And that is an unfair competitive advantage for Mr. Creamer and every other community bank.
Do you want to weigh in, Ms. Pierce?
Yeah, with respect to Glass-Steagall, I don't think that, I mean, I think it's a nice rallying cry, but I don't think that that's going to solve the problem to put Glass-Steagall back.
Because Lehman Brothers was pretty much a pure investment bank, correct?
Right.
Now, in terms of ending too big to fail, some have said, hey, let's just set kind of some arbitrary caps on capital requirements or size. I have concerns about whether members of Congress have the competence to decide those things. So in terms of ending too big to fail, what would be your policy prescriptions in that respect?
Well, if we could trade capital requirements for all the other regulations, then we could pare back a lot of the other regulations that, as Professor Marsh said, have accreted over time. Unfortunately, I think if we do increase capital requirements, it's not going to be at the expense of other requirements. And also, we put in risk-based capital requirements, which don't work as well as a simple leverage ratio. I mean, community banks tend to be more heavily capitalized than the larger banks. And so I think we need to think creatively about perhaps even increasing the liability for shareholders so that if your bank fails, you end up having to kick in some more money. That'll make you pay a little more attention.
Ms. Marsh?
I don't know that it's going to be a magic bullet for anything, but if we're trying to limit the size of these institutions, I think it makes more sense to separate depository institutions from investment banks than it does to put a cap on an artificial cap that you said. I mean, none of us are really in a position to determine what is too big to fail. It makes more sense to split them up functionally, as Glass-Steagall did, than to set an arbitrary cap.
Yeah, I mean, I think some of us, look, I mean, if you're a big bank and you're not getting special policies that give you competitive advantage, and if you're bearing the risk, I think a lot of us are concerned when you have a system of privatized gains and socialized losses. Obviously, there's a moral hazard issue, and there's just an unfairness issue because no one's going to care outside of our community if your bank fails. You're not going to get bailed out, obviously, but when one of the big banks, then they would get a disparate treatment. So that's just a problem with our policy. The gentlewoman from Wyoming, do you have any other questions? Because if you do, I can recognize you to give maybe Mr. Cartwright some time, and then otherwise I'll just probably gavel the hearing to a close.
I do have additional questions,
Okay.
Mr. Chairman.
Chair recognizes gentlewoman from Wyoming for 5 minutes.
Thank you very much. Could I ask any of you to comment on the proposed Basel III regulations?
Well, I mean, I would just say that, first of all, having our regulations decided by central bankers across the world and imposing one uniform standard doesn't seem like the wisest approach to me. But second of all, the focus on risk-based capital, which Basel III embodies, is, I think, a very dangerous approach because it homogenizes the banking sector further and it forces people to try to gain. I mean, it's an invitation to arbitrage. And that's what
isn't it true that banking is more concentrated in Europe than it is in the United States?
It is. We have a much more competitive landscape than Europe does.
So Basel III, Mr. Creamer, would do what to American banking?
Well, to go back very briefly to what Mr. DeSantis had said about regulation incenting some things, first of all, risk-based capital regulation incented residential mortgage loans because they were risk-weighted lower and it required lower capital requirements. In many cases, there's more inherent risk in a residential mortgage loan than there is in an owner-occupied commercial real estate loan to an operating business. In addition to that, Fannie Mae and Freddie Mac put explicit government guarantees. Now, they were implicit at the time, but we all know they're explicit. So when you have an incentive to capital and you have explicit guarantees by the government in a product, you'll probably create a price bubble. Basel III doesn't really address that. Basel III still risk-weight residential mortgage loans at 50%. So there's still an encouragement to make residential mortgage loans. It still risk-weights small business loans at 100%. Right now, each quarter, my bank files a call report. That call report is about 78 pages. All banks file call reports. The call report instructions are 626 pages for that 78 pages. This is a mailer we received last week from a very reputable brokerage firm with a breakdown of Basel III as it relates to community banks. Basel III doesn't simplify that. It makes it more complicated for our staff to calculate. And while they say they have simplified the definition of leveraged capital, I'd simply refer to one section of this, which is about 16 lines of the deductions from what is qualified as regulatory capital. And I am a banker and an accountant by trade, and I don't recognize the acronyms that are in here. And these are the ones that supposedly apply to me.
I hear a lot about Basel III from the banks in my communities, and they're expressing true alarm over them. Another question for anyone on the panel who wishes to address it. The Consumer Protection Financial Bureau has only completed about a little more than a third of its regulations thus far, and they were supposed to have them all completed at this time. So given that, and the fact that the interpretations of those regulations was really given to the regulators, so how's a bank supposed to determine what services you can provide based on rules that haven't been written or rules that haven't been interpreted?
Well, I think Ms. Marsh said it, Professor Marsh said it very well a while ago. It is an accretion of regulation. We already have consumer protection regulations. We have the Federal Reserve alphabet regulations, Regulation A through Y. Equal credit opportunity, home mortgage disclosure, electronic funds transfer, privacy of consumer information, fair credit reporting, truth in lending, unfair deceptive acts or practices, community reinvestment, on and on and on. These laws are very effective. And yes, as Mr. Miller said, there are bad actors. As a community banker who has been doing this for 31 years, I expect bad actors to be dealt with. But it's difficult to deal with the entire industry because of one or two bad actors, and that makes us more difficult. I have heard that the Consumer Financial Protection Bureau is going to make it easier for consumers. Well, these regulations are government promulgated as well, and I'll simply point out to you that under Fair Lending and Regulation Z, this is a residential mortgage application that a consumer that comes into any bank has to fill out and understand.
Yep.
Now, the easiest way to take advantage of a consumer is something like this. Now, I shudder to think what the unwritten regulations that are coming down the pike will do to this and what that will do to my customer who is normally a plumber or electrician or a carpenter who is buying their first home, who has no chance of understanding what this is.
Mr. Chairman, would you indulge one other of the respondents to weigh in on that?
Sure.
Anyone wish to?
Mine, Ms. Loomis, I've heard differently. I've heard that CFPB is doing a better job of hitting their deadlines than any of the other agencies, which may be a low standard, but I think
that's a low standard, I would suggest.
I think they are actually getting their regs in on time. And they've also shown a willingness that Congress rarely shows of adjusting their regulations after they've adopted them. just within the last, either last week or even earlier this week, they just issued a lot of little changes to the QM rules, the qualified mortgage rules, based upon concerns that were raised. Congress tends to enact some big act and then not touch it for a generation. And when the inevitable little things that aren't working exactly the way Congress thought they would work come forward, instead of just fixing that, usually the people who've been opposed to the bill now, point to that as evidence that it should never have been passed, and the people who supported the bill are unwilling to admit any error. So CFPB is actually showing some reasonableness and flexibility and a willingness to listen, and some of what they're doing is designed to make forms more readable, more understandable. The Truth in Lending Act and RESPA, TILA, and RESPA, the Real Estate Settlement Practices Act, required really almost identical disclosures, but not quite identical. And one thing I've heard from when I was in Congress, one of the things I heard from my community bankers and my credit unions was that their lawyers told them that they were afraid to try to take statutory language, which was legalese, and turn it into plain English for fear they might get it wrong. And so with TILA and RESPA, what they would do is set out the statutory language, which no one could read. And with TILA and RESPA, they set out all of TILA and then all of RESPA. So CFPB has issued a form that is both disclosures, TILA and RESPA, on one form that is plain English. That is clearly better for consumers. I assume that Mr. Creamer prefers it as well. And so I think there's some hope with CFPB if part of their mission is to make finance understandable, that they will actually turn unreadable forms into something that can be understood by a normal human being.
I hope so too, Mr. Miller. Everything I hear so far from my community banks and their borrowers, their customers, is to the contrary.
Well, the baseline against which we're working was complete inability to understand anything.
Thank you. I yield back. Thank you, Mr. Chairman, for your indulgence.
Well, we really appreciate the witnesses here. I think you all did a great job. I think what we are trying to establish here is when government takes on, Congress implements, passes these big bills designed to deal with certain issues that oftentimes, we can create new problems and disadvantage smaller institutions vis-a-vis competing with larger institutions, or even just make life more difficult for smaller institutions. So I think we were able to demonstrate that. I think that from what I heard from the comments on the other side, I don't think that many of these folks who probably supported Dodd-Frank want to see community banks harmed, and so there may be some opportunity to get some bipartisan relief from some of the onerous regulations. We talked a little bit towards the end about CFPB, and I think that may be something for another day, but I think that that's going to be something that's very concerning to me, because if you look at the way CFPB is structured, it's essentially immune from any type of congressional oversight. We don't have any way to affect their budget or conduct meaningful oversight. And really, the president is limited in removing the head of that agency, or the head of the board, and the courts are limited in their review of that. So to me, that is problematic. Madison in Federalist 51 said, if men were angels, no government would be necessary. If angels were to govern men, neither internal nor external constraints would be necessary. The way the CFPB is structured, we better hope that he was wrong about that and that these folks are angels, because otherwise I fear that there will be some unintended consequences, or maybe even intended down the, but that is something for another day. At this time, I want to thank again the witnesses for their time, and this hearing is adjourned.